It's been quite a ride, right? It's been almost 5 months now since the election, and we know, of course, that markets always price in the expected future. They don't always anticipate it correctly, but they're always discounting. And so, back in November, when the red wave trade playbook was being adopted, right, a high confidence sense of laissez-faire government, pro-growth, and then kind of the fingers crossed on the tariffs that it would be just a means to an end. The markets actually peaked in November and December, depending on which index you look at. And so, in retrospect, that was a buy the rumor, sell the news kind of thing. And now, of course, we're on the other side of that. We went from pricing a very growthy animal spirits environment to one worried about recession and trade war. And so now, with the so-called Liberation Day being only a few days away, I wonder if it was a sell the rumor, buy the news event that this correction since February 19th will end up being. But we, of course, don't know in real time. And as you just mentioned, pulling over sometimes is not a bad thing to do. Certainly for the Fed, the core PCE on Friday was still printed at 2.8% year-over-year change. That is not low enough for the Fed to really pivot further. So it's rightfully waiting. And in the meantime, the markets are priced for, I would say, a slowdown, down 10%, the Mag 7 down 20%. But I don't think the market is yet priced in for a recession. And we may not get a recession. That's not a prediction. But if the markets were to price a recession that then doesn't happen, then you've got a real clear signal to step back in. But we're not quite there yet.
Okay. In terms of market, what the market is priced in, you're in. Some folks have been noticing that, we've seen some very, very big and volatile moves day to day recently, right? But it's been on very, very thin volumes, right? So this whole metaphor that Tom Barkin is using about pulling over, it seems like, it's not just businesses or consumers, et cetera, who are paralyzed and really don't know what to do and cannot do anything right now. And it could also apply to investors as well. I mean, witness the thin volumes, right? A lot of money has pulled over, waiting for the traffic to clear or for the weather to clear, right? But I mean, for yourself at Fidelity Investments, you don't have that luxury. You need to put money to work, right? So how are you doing that?
Well, so, price discovery is always happening, right? Night and day. Price discovery never sleeps. But sometimes it happens gradually and sometimes it happens quickly, right? So last fall, before the election, when the election was deemed too close to call, the markets just sat around and did nothing for quite a while. And then the election outcome, happened. It was decisive, and the markets instantaneously repriced faster than anyone could change their portfolio. And that's a real lesson for the typical investor out there, is that the markets will always reprice faster than you can. And so the best answer is to have a diversified portfolio. And we all remember, of course, 2022, when the markets were in a bear market, down 28% in the U.S. There was no place to hide back then, right? Bonds were not a port in the storm. They were actually the cause of the storm, and all markets went down. There was no place to hide. The good news is that this time around, with the markets down 10%, there have been lots of other places where you could have hidden. And you mentioned gold. Gold has been, on fire. I think that's in part a de-dollarization play, because if the intent really is to bring manufacturing back into the U.S. and to deglobalize, then you might also be de-dollarizing, because then that flow of dollars from the U.S. to overseas that then gets recycled back into treasuries, that starts to slow down as well. And so international markets have done very well. Of course, Germany had a wake-up call saying, okay, we got to do this on our own. The U.S. may not be there to help us. And so you get a fiscal impulse there. So it's sort of one market's going up, the other one is going down. And for the balanced portfolio, including bonds, you're actually doing okay. You're correcting, but it's not as bad as S&P.